This is episode 09 with entrepreneur and financial advisor, Jason Clevlen.
You may know the destination, but do you know the path to take you there? This is Profits to Wealth. We shorten the time it takes for entrepreneurs to find true success through guided conversations alongside industry elites. We'll cover your commonly asked questions and dive into the skills, tactics, and lessons learned from business professionals who've turned the industry on its head through experience, critical thinking, as well as practical money management. It's time to talk business, money, and freedom with your host, Jack Marino Jr.
Gandhi said, "The future depends on what you do today." Welcome to Profits to Wealth. This is your host, Jack Marino Jr. Today on the show, I'll be speaking with my business partner, Jason Clevlen, about the tax benefits of diversifying your retirement savings. In this episode, Jason and I discuss the general differences between traditional and Roth 401k and IRA retirement plans. We talk about what listeners may want to consider when faced with the decision of which type of IRA or 401k to make contributions to, how to make contributions, and what types of investments can be held in these commonly used retirement plans. Towards the end, we also discuss ways for high-income earners to make Roth contributions and how strategies such as tax bracket maximization and tax diversification can potentially reduce your tax bill in the future. Well, Jason, as we record this today, we have turned the page to a new year, 2020, and also a new decade. So I thought we'd start out today talking about something that's timely, and we're going to talk about retirement plans, some basics around retirement plans, but also get into some more complex topics around retirement plans, taxes, and diversification.
Right. And not to mention tax time's coming up when people are filing their taxes. And a lot of times they're thinking about making IRA contributions. So I think we've got some good information for that today.
Awesome. Well, let's get started. And I figured let's start out with some basics. I don't want to assume that the listener knows a whole lot about retirement savings. So let's start out basically with, some of the more common accounts. What are individual retirement accounts, or many would know them as IRAs, and also 401ks?
Yeah, so those are the most commonly used retirement accounts, and they're very similar in some ways while different in others. There's many types of retirement accounts out there, and if a person is self-employed or an employer, there are a lot of options to choose from, and it depends on their situation and the goal for the plan as to which one makes the most sense. From an investment and tax deferral perspective, 401ks and IRAs are very similar. IRAs and 401ks offer tax-advantaged savings to fund retirement. They have the potential for tax benefits now or in the future. One of the bigger differences are the eligibility requirements and funding limits. For example, with 401ks, the maximum deferral amount for 2020, for the 2020 tax year, is $19,500. And there's an additional $6,500 contribution allowed for employees who are 50 and over. And so, that's a total of, possibly up to $26,000 that could be deferred into a 401k plan for someone 50 and over. Whereas with IRA accounts, the maximum deferral amount for 2020 tax year is $6,000. And there's an additional $1,000 contribution allowed for people who are 50 and up. So we're talking about potential maximum of $7,000. Most people can only do $6,000 on an IRA. So there's a pretty wide gap there as far as the amount that can be contributed to those plans.
Right. And also, I know we're talking mainly about 2020, but for those listeners out there that are obviously entrepreneurs but have a 401k with profit sharing, they could also still do profit sharing for 2019, which the limit on total contributions for a 401k with profit sharing for 2019, I believe, is $56,000.
Yeah, a lot more opportunity to put dollars into 401k and other employer-sponsored retirement plans. And when it comes to the employees, I guess we should say to make a contribution to a 401k, you either need to be a self-employed person that sets one up, or you need to be an employee of a company that offers a 401k plan. And so if your company does not offer a 401k plan, then that's not an option for you. IRAs, on the other hand, can be opened by individuals, can be opened by anyone, and funded regardless of an employer. Although you do need to have earned income in order to make a contribution. So we should note that when you think about these accounts from an investment perspective, they're very much the same. All of these retirement accounts can hold the same investments. So the potential returns on investments are the same. So we should think of these 401ks and IRAs as a shell or a wrapper that holds your investments.
Yeah, we do get that question from time to time. What type of return should I expect on a Roth versus an IRA? And really, although that's a good question, to your point, it really is just a shell or a candy wrapper. You can put almost anything in each one of those accounts. I mean, commonly owned assets are stocks, bonds, mutual funds, exchange traded funds, but there are more assets that you can put in there.
Right. And you mentioned Roth IRAs. A Roth IRA is a variation of an individual retirement account. So there's traditional IRAs, there's Roth IRAs, and same thing for 401ks. You have the traditional, 401k accounts, and there's typically also going to be a Roth 401k option. And the main difference there has to do with tax treatment. And Jack, I think before we go any further, we need to mention that these topics can be complicated. And, we really do recommend that people seek the advice of a financial planner and a tax advisor when they're making these decisions. There's many nuances to these various retirement plans and different eligibility requirements to consider, when making these decisions. And it's a lot more than we can cover in our discussion today. And so I think our goal for this discussion is to increase awareness. So, I highly recommend seeking the advice of professionals. The long-term tax implications and benefits of getting this right can be significant.
I agree with you. Yeah, there's no way we can get into all the nuances there. But I would like to suggest if a listener does have a question that they can go to profitstowealth.com/contact and shoot one of us a question there. But we're also going to put in the show notes a downloadable piece that goes a little bit further and explaining some of these differences. I know over the airwaves, it may be challenging to really comprehend some of what we're going to talk about today. We're going to try not to go too deep, but I do think this is timely. This is a very important part of the planning for financial independence.
Yeah, I agree 100%.
So what's the difference between Roth and traditional then?
Yeah, so I mentioned it's tax treatment. If we think about from a tax perspective how these accounts work, with a Roth IRA or a Roth 401k, a person is making the decision to pay income taxes on the contribution amount in the current year in exchange for tax-free growth on their investment for the life of the investment. So there's no tax deduction when making a contribution to a Roth account. And, the big benefit there is ultimately this is going to create, if it's done correctly, tax-free qualified withdrawals in the future. And in order to get those tax-free qualified withdrawals of the earnings, you have to be at least age 59 and a half, and you have to have had the account for a 5-year aging period. So at least 5-year-old account. With the traditional IRA and 401k, a person is making the decision to receive an income tax deduction today or this year for the contribution amount. Then their investment grows tax deferred until a future date. And once distributions are made from the traditional IRA or 401k, they'll be subject to income tax at that future date. And the rate will depend on, whatever tax bracket they happen to be in at that point in the future. And so to sum it up, contributions to those traditional accounts are made pre-tax. You get tax savings today. The investment grows tax deferred, and then there will be income tax due on the withdrawals in the future.
Right. And the big question mark there is going to be, to what you were alluding to, is the future tax rate. And if we go back in time to, I believe it was the early mid 40s, the highest tax bracket was what, 70, 80%?
I think it got to 90.
90? Wow. Okay. Really not encouraging people to work at that point. So anyway, so the point being that we can't control the tax rate. And part of what we're going to talk about today is, obviously we don't know what's going to happen in the future from a tax perspective, but we can diversify, which is, I know what you're going to get to, by using some of these other type of IRAs or 401ks.
Yes, exactly. And we can try and go through some details of that. Before we do, though, let's mention there are some differences between IRA and 401k accounts when it comes to funding limitations. If we think about the Roth 401k first, there's not any limitation on income. So in other words, it doesn't matter how much income you make or what salary that you receive. Even if you're earning a very high salary, you are still eligible to make new contributions to a Roth 401k. Now, that's not the case when it comes to a Roth IRA. There are income limitations that exist, and it depends on how you file your taxes. So if a single person filing versus a married person that's filing jointly is going to have different income limitations. So in 2020, if a person is married filing jointly and their modified adjusted gross income is less than $193,000, then they would be eligible to make the full Roth IRA contribution for the 2020 tax year. Now, there's a phase-out range, and if they earn over a certain amount, then they wouldn't be eligible to make a Roth contribution at all. And when it comes to funding traditional IRAs, anyone can fund or make a contribution to a traditional IRA. However, there are some circumstances where the deductibility of that contribution can be lost. And generally, that's going to happen if one of the spouses or both have or are covered by an employer-sponsored retirement plan and their modified adjusted gross income is over a certain limit. So in those scenarios, there's the potential where the deductibility of an IRA could be limited or reduced. However, with the traditional 401k, again, there's no income limitations. The participant can contribute all the way up to the maximum allowable contribution, regardless of how much income they make. They do have to have enough earned income, though, to make the contribution.
Right. So just to sort of mirror back to you, let's say traditional 401k, which is probably one of the most common retirement plans out there, that one, there's no income limitation, but there is a contribution limitation. I think that one is common because most employers are setting that one up for the employees. And if I make contributions to the traditional 401k or even a traditional IRA, I'm going to get a my taxes are reduced for the year that I make the contribution, right? And then it grows in their tax deferred. And the big question mark becomes, when I take it out, it's 100% taxable, but I am unsure at what rate. And then on the Roth IRA, Roth 401k, let's start with, Roth 401k doesn't have a income limitation either. It does have the same contribution limitation that a traditional 401k does. But now when you get to a Roth IRA, you do have income limitations. So you can see how listeners and even our clients get really confused on which one can I do, how much can I do, and especially if you're a small business owner and let's say one spouse has a retirement plan at work, let's say a 401k, and then the other spouse is a business owner, it's even more, not necessarily complicated, but it's not black and white on, not always easy, I should say, on which plan they can do, because again, they may be phased out on the traditional IRA, so they may have to utilize one of the small business retirement plans.
Right. And something else to mention just for clarification, if a person, let's give an example, is under 50, so the maximum amount that they can contribute to a traditional IRA or a Roth IRA is $6,000. The total amount that they can put into IRAs is $6,000. So they cannot do $6,000 to a traditional and $6,000 to a Roth. The total amount between the two is limited to $6,000. So they could do 3 and 3, or they could do $6,000 to one or the other. It's the same thing with 401k. You're limited to that $19,500 contribution in 2020. And so all of that could go to traditional. It could all go to Roth, or the 19.5 could be split between the two. And if you change jobs, you're still, let's say you fund a 401k at one company and then you decide to switch jobs and go to work at another, you are still limited to that annual contribution of 19.5 between the two plans.
I see. So I'm sure listeners are thinking this, and because we get this all the time, well, Jason, if I can do both let's say if I have a 401k and I can do 19,000, let's say, into the 401k, and let's say, how do I decide how much to put into the traditional portion and how much to put in the Roth? So how do we make that decision on whether to contribute to both, one or the other?
That's a good question. And we do spend a lot of time talking with people about that. And it ultimately, it's a tax decision. Are you taking the tax benefits now by getting that deduction today? Or are we essentially deferring those tax benefits into the future by funding a Roth and letting it grow tax-free and being able to access those dollars later without any tax consequence? And we can do some math calculations and make some estimates to see which one appears to be better, but we have to make some assumptions in order to do that. And so let me walk you through how we make that, how that calculation works and how we make those decisions. So generally, someone would need to consider what their current marginal income tax rate is today versus a future expected income tax rate. And generally, the preference is going to be to pay the lower rate. So if a person has a marginal income tax bracket today of 35%, and after doing some projections, we expect that they would qualify for maybe a 22% tax bracket during the withdrawal period in the future, then the traditional IRA that gets the tax deduction today, that's going to show to be better. However, the comparison depends on some additional assumptions. If we compare making the maximum annual contribution of $19,500 to a Roth 401k versus a traditional 401k, if both of those accounts are receiving $19,500, then both of those accounts are going to grow to the same balance in the future, assuming they're invested the same way. However, the Roth 401k would be worth much more on an after-tax basis. The Roth funds would be accessible without tax consequence post age 59 and a half, whereas all of the withdrawals from the traditional 401k would be subject to income taxes. So in order to make this a fair comparison, we must also consider the tax savings created by the traditional 401k contribution, and we'd have to perform a calculation assuming that that tax differential gets invested, and grows for the future. So if we assume that same 35% marginal tax bracket, then there would be approximately $6,825 of tax savings to invest in a taxable account thanks to that $19,500 contribution. So that's where it starts to get a little more complicated as we think about this calculation. And then if you can also think about this from a cash flow perspective. If we're still assuming that 35% marginal tax bracket, a contribution of $19,500 to a traditional 401k, so that's pre-tax, would have the same cash flow impact as a $12,675 contribution to a Roth 401k because there's no tax deduction for that. And so in reality, what I often see happen is most people don't actually invest the tax savings. They spend it. So in which case they would have been better off having done the Roth regardless of what the math shows.
Yeah, that's true. Yeah, I'm glad that you pointed that out because I was going to say that when we run these calculations, we always emphasize that you need to save that difference to make that outcome the way that we've illustrated here. And again, we'll put a link in the show notes to an example because this does start to get a little bit more complicated, especially, if you're not looking at this
Right.
visually. But I think it is important. This is a very important topic because we actually get this question, as I mentioned before, a lot is, should I 50-50 this? And without seeing the numbers, without knowing their situation, there's no way to answer that question on what amount should they do in the Roth versus traditional.
Right. It's very helpful to take a look and see, what is that current tax bracket? And then, I mentioned it's an assumption we have to make about that future tax rate. And so we can base that on the current tax tables today and say, well, it looks like, based on the retirement plans that you've made, that you're going to be drawing this amount out during retirement. That would put you in a lower tax bracket. And assuming the tax brackets stay the same as they are today, then you might be in a 22% tax bracket versus the 35% tax bracket. But who knows? Tax brackets, as you mentioned, were much different back in the 40s than they are today. And over the last 20 years, we've had some significant tax overhauls that we've seen completed. So, it changes the way the tax brackets work and what percentages people pay. So, who knows 20 years from now, what tax rates are going to look like. And so, like I said at the beginning, you have to make some assumptions, and regardless of what the math says, is certainly nice to accumulate some of those tax-free dollars in a Roth account just to give you options later on in the future in case things don't go as planned when we think about tax rates.
Yeah. Not even to, on top of that, which we won't go in today, but there are some other reasons why, or benefits of the Roth 401k, Roth IRA, which are from an estate planning perspective as well. But this is an exact reason why we say financial planning is more of an art than science. Now, there is some science or some laws here, but there is a lot of times a lot of art. It's not black and white because you do have to make a lot of assumptions that may or may not be true in the future. So how would, I make contributions, or how would someone make these contributions or fund one of these accounts?
Yeah, so 401ks, those are funded generally through payroll deductions. And many employers also offer matching contributions. That's to incent participation. In addition to matching contributions, some employers also do profit sharing contributions. And so that's all fantastic. We absolutely want to make sure clients are taking advantage of any available matching contributions that an employer is offering. That's free money. For IRA accounts, the contribution can be made at any time during the tax year, and contributions can also be made for a prior tax year up until April 15th. And generally that should be done by the time a person files their taxes if they file earlier than April 15th.
Okay. What about, are there ways for listeners to get money into Roth accounts? Let's say if they don't have a 401k, or let's say they're in a very high tax bracket, but they still want to get the benefit of pre-tax contribution in the current year.
Excellent question. So yes, there are some options. One of the first one is a strategy that's called the backdoor Roth. And essentially what has to happen here, or the way this works the best, is if a person doesn't have any other IRA funds. If that's the case, then this strategy is pretty straightforward. And what a person would do is they would make a contribution to their traditional IRA on an after-tax basis. So how do you do that? You just don't deduct it.
Okay.
Yep. And once you have that after-tax amount in the IRA, then you do what's called a conversion of that amount to a Roth IRA. And anyone can do a conversion. There aren't any income limitations on this. So that's not anything that we need to worry about. And if we are only converting after-tax dollars, then there's no tax consequences for the conversion. If a person has other funds in an IRA, even if that IRA is held somewhere else that are, pre-tax dollars, then any pre-tax dollars that get converted, a person must pay tax at their current, marginal income tax rate. And, any dollars that are converted could also potentially push a person into a higher tax bracket. And if they already have pre-tax dollars in an IRA somewhere else, the IRS does not allow a person to segregate those dollars. So you can't just go grab the after-tax contribution and convert that. They make you do a prorated conversion if you're only doing a partial conversion. So a portion of that conversion would be taxable. So it gets a little messy if there's multiple IRA accounts and pre-tax dollars in there. It's very simple if a person doesn't have any IRA assets, and the only thing that we're looking at is this after-tax contribution being made.
Right. I know we've gotten that question a lot of times. Well, can't we just set up a new IRA and do this? But like you mentioned, the IRS sees your traditional IRAs all as one. It didn't matter if you have 2 or 10, it all is one. And it will forever be an accounting nightmare if you do this conversion and you have another traditional IRA.
Right. If you put after-tax dollars in and you don't convert all of it out, and then you have to keep track of that forever in order to make sure you're not paying tax on dollars that you've already paid tax on. And there's a chance someone could forget, and then eventually they pull that money out and they pay tax on it again.
Right.
If they didn't account for it properly. Now, the rules are a little bit different with 401ks. There's another strategy that sometimes is called the mega backdoor Roth. And this is essentially that backdoor Roth strategy, but on 401k plans. And unfortunately, this cannot be done on all 401k plans. Generally, it's the larger companies that are able to set this up. That has to do with some of the testing requirements that these 401k plans have to meet.
Such as? Do you have an example
of the testing requirements?
A company that will allow this?
Oh, I've seen IBM and Apple. There's a lot of companies out there that offer that, but it is generally the larger companies that have a lot of employees that are able to do this. So not every 401k plan can offer this mega backdoor Roth strategy. And basically the way it works is you're able to still make your normal contribution to the 401k plan. So if you are a high income earner and you're in a high tax bracket, maybe you still want to get that tax deduction for the 401k contribution. So you could still put your $19,500 in on a pre-tax basis. But then the plan, if it allows for it, you can also make additional after-tax contributions to the 401k plan during the year. And the 401k plan will set some limits on how much that you can do. That'll be outlined within that summary plan description. But those after-tax dollars that you put into the 401k plan, we can segregate those from the pre-tax dollars and convert just the after-tax amount into a Roth account. And a lot of plans these days will allow you to do that whole conversion within the 401k plan, so that it can be very simple, and even some of that can be automated. They also will oftentimes allow you to take that after-tax portion and convert it out of the 401k into a Roth IRA rather than the Roth 401k. So there's some flexibility and some options there on how you execute this strategy.
That can be, that is not this is a relatively newer strategy and not very well known.
Not many people know about it. That is for certain. And what's interesting is the potential is very significant. There's a lot of dollars that can potentially go into the plan on an after-tax basis, and that can help rapidly accumulate a Roth account balance. I've got some clients that are funding around $25,000 a year on an after-tax basis into their 401k plans that we're converting every year into Roth. And that's in addition to the other pre-tax contributions that they're making. So they're not missing out on any tax deductions in the current year. And we're using this mega backdoor Roth strategy to build up a sizable Roth account balance that's going to benefit them later on.
That's a huge benefit. So yeah, any listeners want more information about that, be sure to contact us. We can help you with that. Let's talk about tax bracket maximization. So listeners may or may not have heard that before, but it's something that we've been using for a long time. And I know the accountants use this as well. So what is it?
So tax bracket maximization, a lot of people think about primarily applying this to retirees, but really it can apply to anyone. It has to do with taking advantage of a person's low marginal income tax rate. So if someone is in a low tax bracket, they could selectively convert a portion of their traditional IRA into a Roth account to recognize some income and fill up the remaining portion of the current bracket that they're in. So maybe they're in a 12% tax bracket, and they could convert a part of their account and recognize some income so that they fully maximize up to the limit of that 12% tax bracket. Now, this takes some planning because the conversion has to be done within the tax year. And so essentially, if you were doing this in 2020, you have to complete the conversion during the 2020 tax year. And a lot of times people don't have the full, clear information on their tax situation until they're filing their taxes, which occurs in the next year, right? So in early 2021, everyone's filing their taxes for 2020. However, we have to do this during the 2020 tax year. So it takes a little planning. It takes a little thought. We have to put pencil to paper and do some calculations and some estimates to figure out how much can we convert in order to maximize what we think their current tax bracket is going to be.
Right. And we'd also want to work with their tax professional.
Absolutely.
To have them run the calculations as well, just to make sure that nothing's missed, because it gets pretty complicated. That the overall strategy is not, but there's a whole lot of moving parts with someone's taxes and the ramifications of the pre-tax versus the Roth.
Yeah, planning it all out is the complicated part. Understanding the benefits of the strategy is pretty simple. And a lot of times we think about retirees for this because they're no longer working. They're not necessarily earning a paycheck anymore, so there's a high potential that they're in a much lower tax bracket. However, this can apply to anybody. Sometimes we find ourselves in a year where we're just in an abnormally low tax situation than what we have been in the past. Maybe a person is between jobs, or they, took some time off and they earned much less income than they normally do, and they find themselves in a really low tax bracket. That could be an opportunity for someone to do a conversion of a portion, of their retirement account to take advantage of that low tax bracket.
Not that it would be a good scenario, but we've definitely seen it where you have a business owner that had a really big loss, and that's a perfect example to have like a silver lining, use that bad year for the greater good in the future.
Yeah, maybe they bought a lot of equipment and they just had significant write-offs that, reduced their income so much that they showed a loss. If they have that ordinary loss, they can actually convert a portion of their retirement account, and that income that they recognize from the conversion can be used to just offset that loss. And essentially, they're getting money moved tax-free,
right,
from one of those pre-tax retirement accounts over into a Roth account that's now growing tax-free for the future.
Yeah, that's another good way. I mean, it's not too common, but we do see that. It is, I think, to your point, it is more common that we see the opportunity when someone's more on a fixed income at a point where they're maybe already retired or reached that financial independence.
Yes.
So we've all heard of investment diversification, where we don't want to put all of our eggs in one basket. think everyone understands the logic around that. But what about tax diversification?
Yeah, so that's another thing that a lot of people haven't heard of and really haven't given any thought to. And that's something that we pay quite a bit of attention to when we are doing retirement planning and financial planning. And like you said, when it comes to investments, we diversify. We don't know necessarily which investment is going to do well or which one is not. And so we spread the risk out and we own, a basket of different investment securities, right? We diversify. Well, think about with our taxes, we don't know what tax rates are going to be like in the future. We don't know if they're going to be higher than they are today or if they're going to be lower than they are today. And so we don't know for sure whether saving on a pre-tax basis makes the most sense or saving post-tax or putting money into a Roth. And so in an ideal scenario, a person would be accumulating dollars in various types of accounts. So they would be accumulating some pre-tax dollars and getting some tax savings today. They would be accumulating some money in these Roth accounts that are growing tax-free. And then they would also have some investments in a, individual taxable account that would be, potentially subject to capital gains. And by diversifying your investments from a tax perspective, by creating this tax diversification, it gives a person flexibility and more control over how much they pay in taxes later on in life. And so if we think about that for a second, some people may be wondering, what did he just say? And so once a person retires and they're no longer earning a salary, you're going to be potentially taking withdrawals from these various accounts that we've accumulated. Well, these withdrawals are taxed differently. So if we take money out of that traditional 401k or traditional IRA, that's going to be subject to income tax, and that's what's going to determine what tax bracket we're in and how much taxes we pay. Well, if tax rates happen to go up a lot from what they are today, well, the government's going to be getting more of that account than what you might have originally planned. However, if you have accumulated dollars in other types of accounts, then you can supplement your income maybe from your Roth account. And when we take money from these Roth accounts, assuming we meet the qualifications of 59 and a half and have had the account for 5+ years, then that money comes out tax-free and that does not impact our tax bracket. And so we can use that to leverage how much income tax we have to pay because we can control how much we pull to a certain extent out of those pre-tax accounts and make sure that we fall in a lower tax bracket. And that might open the door to other tax savings opportunities. If you're in one of the lower two tax brackets, you actually qualify for a 0% long-term capital gains rate. And so we can create quite a bit of tax savings by planning ahead and creating this tax diversified scenario.
So it's giving yourself some options because, again, as we mentioned earlier in the show, you can't control the tax rates, nor do we know what the tax rates are going to be in the future. So it's having your investments, your nest egg in different types of tax accounts, Roth, you've got traditional IRA, and then you've got your non-qualified regular taxable investments, and
Right.
having that three, if you will, we call it the tax triangle, can really decrease the amount that you end up handing the IRS.
Exactly. And let's say you retire and you've accumulated funds in these various types of accounts, and maybe Congress, for whatever reason, puts some new tax laws into place and tax rates go up significantly. And during those years, you might decide to pull more money from your Roth IRA accounts it's going to be tax-free, and less from those traditional IRA accounts that you have to pay income tax on to keep your tax bill low. And maybe you're hoping that new Congress will come in 4 years, or new president, and they'll overhaul the tax legislation and lower tax rates in the future. And if that happens, well, then maybe in those years you would lean more on those pre-tax accounts and pull it out while it's getting a more favorable tax rate. So it gives you that flexibility and increases the likelihood that you're going to pay less in taxes over time.
So I think the bottom line here is that, there's a lot of different type of retirement plans and they have different tax implications. Don't do just what's easy, right? Which is most commonly either a traditional IRA or basically anything on the pre-tax side. That's the most common. I think the bottom line is you need to work with your financial professional, your tax professional, and find out how you can tap into or utilize some of these other retirement vehicles. That way you have the opportunity in the future to really have more control over, when and how you take those distributions, and then the net effect of your taxes hopefully is lower as a result of those proactive planning.
Right. And we're, doing this right is the difference in saving tens of thousands to hundreds of thousands of dollars in taxes.
Yeah, easy.
Over time. Yeah.
Right.
I mean, significant. We're talking significant tax savings if these strategies are executed correctly.
Right. Because financial independence or retirement on average is over 2-3 decades, if not more. And you think about little tax savings that you save every year, compounded over 20, 30, 40 years is a lot of money. So definitely visit the website and download the link that we'll put in this show notes. And if you have questions, reach out to us. As I mentioned before, profitstowealth.com/contact. And this has been great. So I really appreciate your time, Jason. Before we go, though, maybe you should give the listeners a financial tip of the week outside of what we talked about today.
I think I'm going to stay on topic here. And tip of the week is going to be look for an opportunity to start up a Roth account. Start creating that tax diversification and create an account that you can access in the future without any tax consequences at all.
Great advice. So again, if anyone has any questions, please submit those questions to us. We'd love to hear from you or any feedback that you have. Jason, again, this has been awesome. I really appreciate your time and insight here. Look forward to our next show.
Good stuff, Jack. Can't wait for the next one.
That's all for this episode of Profits to Wealth. But we have more resources available to you on our website. Head over to profitstowealth.com and take our questionnaire to find out how we can provide you with a tailored approach to your entrepreneurial journey. It's available exclusively on profitstowealth.com. Until next time, we look forward to talking business, money, and freedom right here